Hello class, this is chapter 4, the final video for financial accounting. This is financial statement analysis, again chapter 14. So these are the learning objectives. Go ahead and take a look at them. So describe the techniques and tools used to analyze financial statement information. Describe and illustrate basic financial statement analytical methods. Describe and illustrate how to use financial statement analysis to assess liquidity. Describe and illustrate how to use financial statement analysis to assess solvency. Describe and illustrate how to use financial statement analysis to assess profitability. Describe the contents of corporate annual reports. Describe the reporting of unusual items on the income statement, and describe the concepts of fair value and comprehensive income. So financial statements, general purpose financial statements are distributed to a wide range of potential users, providing each group with valuable information about a company's economic performance and financial condition. Users typically evaluate this information along three dimensions: liquidity, solvency, and profitability. We'll take a look at what those mean. Liquidity, short-term creditors such as banks and financial institutions are primarily concerned with whether a company will be able to repay short-term borrowings such as loans and notes. As such, they are most interested in evaluating a company's ability to convert assets into cash, which is called liquidity. Solvency, long-term creditors such as bondholders loan money for long periods of time. Thus, they are interested in evaluating a company's ability to make its periodic interest payments and repay the face amount of debt at maturity, which is called solvency. Profitability, investors such as stakeholders are interested in evaluating the potential for the price of the company's stock to increase. As such, investors focus on evaluating a company's ability to generate earnings, which is called profitability. Techniques for analyzing financial statements. So financial statements users rely on following techniques to analyze and interpret a company's financial performance and condition. Analytical method, examine changes in the amount and percentage of financial statement items within and across periods. Ratios, express a financial statement item or set of financial statement items as a percentage of other financial statement item in order to measure an important economic relationship as a single number. Both analytical methods and ratios can be used to compare a company's financial performance over time or to another company. Comparisons over time, the comparison of a financial statement item or ratio with the same amount item or ratio from a prior period often helps the user identify trends in a company's economic performance, financial condition, liquidity, solvency, and profitability. Comparisons among companies, the comparison of a financial statement item or ratio to another company in the same industry can provide insight into a company's economic performance and financial condition relative to its competitors. So users analyze a company's financial statements using a variety of analytical methods. Three such methods are the following: horizontal analysis, vertical analysis, common size statements. Okay, so we'll take a look at those. The analysis of increases and decreases in amount and percentage of comparative financial statement items is called horizontal analysis. Each item on the most recent statement is compared with the same item on one or more earlier statements in terms of the following: amount of increase or decrease, percentage of increase or decrease. When comparing statements, the earlier statement is normally used as the base year for computing increases and decreases. So here's a comparative balance sheet, and this is a horizontal analysis. So right here shows 2016, 2015, and then an amount increase or decrease, and then you give the percentage as well. Comparative schedule of current assets, horizontal analysis. We kind of looked at this a little bit earlier in a previous chapter, but again, the whole semester we've been looking at horizontal analysis, a comparison to look at increases and decreases, okay, and a percentage increase and decrease. So here's an income statement horizontally analyzed, so take a look at that as well. Comparative retained earnings, again, looking at it how we did compared to a previous year. Keep in mind, financial statements are used to compare your profit to compare how you did to a previous year. So that's why we look at these horizontally. Vertical analysis is the percentage analysis of the relationship of each component in a financial statement to a total within the statement is called vertical analysis. In a vertical analysis, the balance sheet, the percentages are computed as follows. Each asset item is stated as a percentage of the total assets. Each liability and stockholders' equity item is stated as a percentage of total liabilities and stockholders' equity. So here's what this looks like. Comparative, this is vertical, this is the balance sheet. So vertically, we're looking at how it compares, even though there's a little bit of horizontal analysis, but we're looking at it as a percentage there, and then as a percentage of here. Don't forget assets equal liabilities plus owner's equity. That's why we look at it in that method. In a vertical analysis of the income statement, each item is stated as a percentage of sales. Okay, so here's a percentage of sales, and this is where we look at. So our net income is 6.1%, operating income is 10.7%, and again, like it says right here, as a percentage of sales. Okay, so that's the key whenever you're looking at an income statement. In a common size statement, all items are expressed as percentages with no dollar amounts shown. Common size statements are often useful for comparing one company with another or for comparing a company with industry averages. So here's common size income statement. So we're looking at two companies to see how we compare to another company. Operating income is 10.7 to 14.4, and then 6.1 to 9. So if I'm here, I'm like, okay, what's going on with this company? What is it they're doing? Why is their net income 9% when mine is only 6.1%? So you look at those two. So they have more revenue right here. That's a big one. They have more operating income. We have less. So those are some things. Look at their cost of goods. They're pretty much the same, although our administrative expenses are higher, 6.9, almost 3.3 percentage points higher than this company. So something's going on there. So look at our total operating. The difference is about almost 4% difference there. So those are some things that you look at whenever you compare company to company, or industry averages as well. So let's take a look at this. Select income statement data for, I don't even know how to say that, Bukase Company for 2 recent years ended December 31 as follows. So in the previous year was 2, so we had an increase of 100,000. Our cost of goods also went up. Our gross profit did increase. So what held steady for the most part was our cost of goods. Well, they actually both increased, but our gross profit did increase some. So our administrative, typically when you increase like that, your administrative expenses do increase as well. So our operating income did increase by about 77,500. Prepare horizontal and vertical analysis. Okay, so here's what this will look like. So we're just doing this as a percentage. Okay, so operating income is at 20%, sales is 10%, COGS is, I just said COGS 7%, gross profit is 15%. So then we're looking at this. This is horizontal, this is vertical. Notice the difference. Where horizontal is just this way, vertical, we're adding the percentages right here, okay, and comparing them. So keep those things in mind. Analyzing liquidity. Liquidity analysis evaluates the ability of a company to convert current assets into cash. Liquidity ratios and measures focus upon a company's current position, current assets and liabilities, accounts receivable, and inventory. So liquidity ratios and measures. So working capital, current position, current ratio, quick ratio, accounts receivable turnover, number of days in sales. We've kind of went over some of this before in a previous chapter when we were looking at inventory. Inventory analysis, inventory turnover, and number of days sales in inventory. Current position analysis. Current position analysis evaluates a company's ability to pay its current liabilities. This information helps short-term creditors determine how quickly they will be repaid. This analysis includes the following: working capital, current ratio, and quick ratio. A company's working capital is computed as follows: working capital equal current assets minus current liabilities. So here's an example: our current assets and current liabilities, and there's our working capital, which is you just subtract your liabilities from your assets. Okay. The working capital is used to evaluate a company's ability to pay current liabilities. A company's working capital is often monitored monthly, quarterly, or yearly by creditors and other debtors. Now, however, it is difficult to use working capital to compare companies of different sizes. Okay. Current ratio, sometimes called working capital ratio, is computed as follows. Current ratio equals current assets over current liabilities. So for this particular situation, 2.6 and 2.2. So that's 2.6 times, and we can repay our current liabilities. And the previous year was 2.2. So we want this number to be higher. So keep that in mind. We want the number, the current ratio, to be higher. So the current ratio is a more reliable indicator of a company's ability to pay its current liabilities than is working capital, and is much easier to compare across companies. So a quick ratio, we'll take a look at the quick ratio. It's also called acid test. If you go into a finance class, these are things you look at to look at a company as well. So quick ratio is quick assets over current liabilities. Quick assets are cash and other current assets that can be easily converted to cash. Quick assets such as cash, temporary investments, and receivables, but exclude inventories and prepaid assets. So here's a couple of examples. Here's Lincoln and here's Jefferson, 2.6, and they're both 2.6. So they're both very, very similar, and whenever we compare them, that's what we want. So we want to be as liquid as possible, okay? But the thing that to understand too is a lot of times you want to compare what your company is to the industry. This is just comparing to one company. A lot of times you can say in this particular industry, it's usually a 1.2. So if we're at a 2.6 and the industry is a 1.2, then you're doing better than the industry average. So here's another example. So this is the quick ratio looking company to company. This is 1.3 and this is 0.8. So you definitely, Lincoln Company is in a better position than Jefferson Company. Accounts receivable analysis is a company's ability to collect its account receivable is called accounts receivable analysis. Account receivable analysis includes a computation analysis of the following: accounts receivable turnover, number of days sales, and receivable. So these, whenever I get board reports for Nappy, the big farm south of Farmington, these are things we look at. In fact, we get a weekly update on these. I guess it's a standing weekly, but for the most part, we get them monthly and quarterly to make decisions for the company. Collecting account receivable as quickly as possible does the following: improves a company's liquidity, provides cash to improve or expand operations, reduces the risk of uncollectible accounts. Accounts receivable turnover is sales divided by average accounts receivable. So here's an example. So we have 117.5, which we get 235 divided by 2, so 12.7. In 2015-ish, 130, which is 260 divided by 2. That's our average account receivable, and then our accounts receivable turnover is 9.2. Okay. So 120 divided by 130,000. Number of days sales and receivable is computed as follows: average account receivable divided by average daily sales, or sales divided by 365 days in a year. So here's an example. So average accounts receivable is 117,500. Average days sales is 41.5, so 28.6. Now in 2015, 130 divided by 3,288, so will be 39.5. Okay, so that's how we calculate it, and it's broken down right here if you want to get more detail into it. So the number of days sales and receivable is an estimate of the time and days that accounts receivable have been outstanding. The number of days sales and receivable is often compared with a company's credit terms to evaluate the efficiency of the collection of receivables. Inventory analysis, a company's ability to manage its inventory effectively, is evaluated using inventory analysis. Inventory analysis includes the computation and analysis of the following: inventory turnover, number of days sales and inventory. Excess inventory is the following: decrease liquidity by tying up funds, cash, and inventory. Increases insurance expense, property taxes, storage costs, and other related expenses. So you want your inventory going out quickly, okay? Increase the risk of loss because of price declines or obsolescence of inventory. So inventory turnover is cost of goods sold divided by average inventory. So here's an example. So COGS is 1,043,000. Previous year is 820. Beginning of the year is 283. And end of year is 264. So total is 547. Previous year was 594. Average inventory is 273, which we take this number divided by 2. Same with this number. So then we go this number divided by that, which gives us 3.8. So 2.8 as well. Okay. So there's how you calculate inventory turnover. So number of days sales in inventory is average inventory divided by average daily cost of goods, or cost of goods divided by 365 days. So here's an example. Here's our cost of inventory, average daily inventory. Here's our average daily cost of goods sold. So we divide this number by that number, same here. So this is 132.2 and this is 195.7, okay? So these are just examples of how you calculate these. The number of days sales in inventory is a rough estimate of the length of time it takes to purchase, sell, and replace the inventory. Okay, so keep these things in mind. Here's another checkup corner. Quick ratio, current ratio, account receivable turnover, and inventory turnover. So we'll take a look at this in this example, as this is the same thing that's in your book as well. So here's our current ratio is going to be 1.9, our quick ratio is 1.5, our accounts receivable turnover is 10, and our inventory turnover is 8. So here are all the actual, what do you call them, how you calculate them, your formulas, and then here's actually, it breaks it down where the numbers come from. Analyzing solvency. Solvency analysis evaluates a company's ability to pay its long-term debts. So solvency ratios, ratio of fixed assets to long-term liabilities, ratio of liabilities to stockholders' equity times interest earned. So those are ways to determine rates of fixed assets and long-term to long-term. Fixed ratio of fixed assets to long-term. So you minus long-term, or long-term liabilities is fixed assets, then net divided by long-term liabilities. So that's how we calculate it. So for this example, it's going to be our fixed asset divided by 100,000, our liability, same with this one. So 4.4 and this one's 2.4. All we did was divide this and then divide these as well, okay? Ratio of liabilities to stockholders' equity is total liabilities divided by total stockholders' equity, okay? And the ratio of liabilities to equity is computed as follows. So indicates a margin of safety for creditors. Keep in mind, these are all for internal and external people that make decisions. Like it says, creditors or board or people that are going to invest in the company. So 310 divided by 829,500 gives us 0.4. And on this side, it gives us 0.6. Times interest earned is calculated income before tax. Income tax plus interest expense over interest expense. And this one, this is called the coverage ratio, measures the risk that interest payments will not be made if earnings decrease. So the higher the ratio, the more likely interest payments will be paid if earnings decrease. So this one, so you want a higher rate. So this is 28.1, this is 12.2. So we've had a better year this year. So here's another, I'll go and let you go do this checkup corner. Go ahead and go through that. It's also in the book if you need to look at it to take a deeper analysis of these. But here's what its requirements what it's asking you to do, which is similar to the homework. So here are the answers. So go ahead and take a look at that on your own. Profitability analysis. Profitability analysis evaluates the ability of a company to generate future earnings. This ability depends on the relation between the company's operating results and the assets the company has available for use in its operations. Thus, the relation between income statement and balance sheet items is used to evaluate profitability. So here are the ratios: asset turnover, return on total assets, return on stockholders' equity, return on common stock, return on common earnings per share, on common stock price earnings ratio, dividends per share, dividend yield. So asset turnover is going to be sales divided by average total assets, which excludes term investments, excluding long-term investments. Note that long-term investments are excluded in the computing asset turnover because long-term investments are unrelated to normal operations and sales. So here's the example. Again, it breaks it down for you. these numbers. These can help you figure out some of the homework as well. So return on total assets is net income plus interest expense divided by average total assets. So here's the example. 2,370,000 divided by 2, and then this one is 2,418,000 divided by 2, and then from there we go our interest and expense 97 divided by 1.185 million, 8.2%. This is 88,500 divided by 1.209 million. Okay. All right, and then a return on operating assets. Operating income divided by average operating assets. And then return on stockholders' equity is net income divided by average total stockholders' equity. Okay, so here's an example for these two examples. We'll go 1.9 or 91,000 divided by 808,500, 11.3%, and in the previous year was 10%. Okay, so the return on stockholders' equity is normally higher than the return on total assets. This is because of the effect of leverage. Leverage involves using a debt to increase the return on an investment. So return on stockholders' equity, so in previous year is 3.1%. Well, this year was 3.1%, previous year was 2.1%. Okay. So let's see. Effects of leverage 2016. So the leverage was, the difference was 3.1%, and on this side was 2.1%. Okay, this is a really good graphic of what that would look like. Return on common stockholders' equity is net income minus preferred dividends divided by average common stock equity. So here's what this looks like. This one's a little bit more complicated.